Hello everyone, and welcome to our Proactive Year-End Tax Planning online video seminar. Today's agenda is straightforward. We will review year-end tax planning. While doing so, we will discuss some tax planning ideas and strategies you can consider. We will also discuss some key tax proposals that are currently being discussed. We believe in educating our clients on their choices. Our goal today is to give an overview of tax planning so that when you look at your situation, you have some strong foundational information. Please remember each taxpayer situation should be looked at individually. The good news is we are available to talk with you about the specifics of your situation. I find it always important to review that there are 5 key areas of financial planning. These areas are preservation planning, retirement planning, tax planning, estate planning, and investment planning. Today's presentation is about tax planning and estate planning. As a comprehensive wealth management firm, we try to always consider the impact of any recommendation we make on not just one, but all these areas for our clients. Tax planning for 2021 became a little more complicated because of the passing of some new rules and laws from the Secure Act, which signed into law in December of 2019, and the 2020 CARES Act also added some new rules and laws for taxpayers. With the recent proposal of new tax laws from the Build Back Better and other potential tax law proposals, it is helpful to review some of the tax law changes that are being discussed so that you can plan in an informed way. Let's start by quickly distinguishing the difference between tax planning and tax preparation. Tax planning is looking ahead before year-end, whereas tax preparation is filling out your tax forms after year-end. This workshop is about tax planning, not tax preparation. It is about hearing some proactive ideas that you can consider now to potentially reduce your taxes. One of our founding fathers, Benjamin Franklin, is credited with saying, "By failing to prepare, you are preparing to fail." For 2021, there are still 7 tax rates. These rates are 10, 12, 22, 24, 32, 35, and 37%. Under current law, this 7-rate structure, which was created by the Tax Cuts and Jobs Act, is scheduled to automatically phase out on January 1st, 2026. For 2021, the standard deduction amounts for those who do not itemize are $12,550 for individuals, $25,100 for married couples filing jointly and surviving spouses, $12,550 for married couples filing separately, and $18,800 for heads of households. So how should you view itemized deductions if you do not take the standard deduction? The old rule was to accelerate or realize deductions and take them as soon as possible. With the higher standard deductions, the new rule is to time or plan deductions. 2 of the more widespread deductions that taxpayers look at if they choose to itemize and not use the standard deduction are mortgage interest and state and local taxes, also known as SALT. Under the new rules, for mortgages taken out after October 13, 1987, and before December 16, 2017, mortgage interest is fully deductible up to the first $1 million of mortgage debt. That threshold has been lowered to the first $750,000 or $375,000 married filing separately on homes purchased after December 15, 2017. For those of you with mortgages, please check with your tax preparer for how much of a deduction you could take. The Tax Cuts and Jobs Act also limited state and local income, sales, and real and personal property taxes, SALT again, to a maximum deduction of $10,000. There's been discussions about changing this, but currently the $10,000 limit is still in place. Qualified charitable distributions, QCDs, are still a strategy for retirement savers. As part of the Secure Act, required minimum distributions, or RMDs, were changed to start at age 72 instead of 70 and a half. Qualified charitable distributions are a tax law provision that allows retirement savers over age 70 and a half to directly distribute up to $100,000 to eligible charities straight from their retirement accounts and not pay tax on this distribution. One idea that experts suggest is if you are charitably inclined, consider using part or all of your required minimum distribution, or RMD, for a qualified charitable distribution. Like many of the other strategies we are discussing today, this is one you should see us about if you're interested in evaluating your situation. In 2021, long-term capital gains still receive a tax break. Here are the three tax rates of 0, 15, and 20% for long-term capital gains. One planning item that many taxpayers think about is tax gains and loss harvesting. Harvesting capital losses is a strategy that has a taxpayer selling assets that are at a loss to offset capital gains. This reduces or eliminates tax on current capital gains. On the surface, loss harvesting produces an economic benefit equal to the tax saved. However, sometimes it could only provide a timing benefit. This is a tax deferral strategy that could be valuable. Capital losses are highly tax effective if they can be used to offset income tax at higher rates. A key fact to remember is you can use up to $3,000 in capital loss above capital gains to offset ordinary income. Also, as a warning, watch out for the wash-sell rule. This rule prevents taxpayers from repurchasing a substantially similar security or the same security within 30 days of selling at a loss. If you have any questions on loss or gain harvesting, call us or your tax professional. Capital gains harvesting means taking capital gains in the current tax year. On the surface, it might appear that taxpayers should always harvest gains because of favorable rates. However, harvesting gains introduces a trade-off between lower tax rates versus the loss of tax deferral. Remember, when taking a gain for tax purposes, although the tax is paid at a lower rate, it is paid sooner. Remember to review your year-end retirement contribution planning. Here are some contribution plan maximums that could be applicable if you are participating in one of these plans. Another critical area to review before year-end because of the Secure Act is what we refer to as overall family tax bracket management. Logically speaking, if you are in a higher tax bracket than your beneficiaries, then it might make sense to let them take distributions after your death in their tax bracket rather than you in yours. However, if your beneficiaries are in a higher tax bracket, then it might make sense to take distributions in your tax bracket before death, and then to convert these accounts to Roth IRAs and leave your beneficiaries an account that still must be taken out in 10 years, but can grow tax-free. An annual step to consider is to review your marginal tax rate and your beneficiaries' marginal tax rates each year. Some benefits from Roth IRA conversions include: first, they could lower your overall taxable income long term. Roth IRAs also enjoy tax-free compounding. Roth IRAs have no RMDs at age 72, which start with a traditional IRA. They start at age 72. Roth IRAs allow tax-free withdrawals for beneficiaries. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. Qualified tuition plans, also named 529 plans, are a great way to tax efficiently plan the financial burden of paying tuition for children or grandchildren. Originally, earnings in a 529 plan could be withdrawn tax-free only when used for qualified higher education at colleges, universities, vocational schools, or other post-secondary schools. However, the rules change, so now 529 plans can also be used to pay for tuition at an elementary or secondary public, private, or religious school, up to $10,000 per year per student. Unlike IRAs, there are no annual contribution limits for 529 plans. Instead, there are maximum aggregate limits, which vary by plan. Under federal law, 529 plan balances cannot exceed the expected cost of the beneficiary's qualified higher education expenses. 529 plan limits vary by state, ranging from $235,000 up to $529,000. Some states even offer a state tax credit or deduction up to a certain amount. Contributions to a 529 plan are considered completed gifts for federal tax purposes. So in 2021, up to $15,000 per donor per beneficiary qualifies for the annual gift tax exclusion. Excess contributions above $15,000 must be reported on IRS Form 709, and they will count against the taxpayer's lifetime estate and gift tax exemption amount, which is currently $11.7 million. There's also an option to make a larger tax-free 529 plan contribution if the contribution is treated as if it were spread evenly over a 5-year period. For example, a $75,000 lump sum contribution to a 529 plan can be applied as though it were $15,000 per year, as long as no other gifts are made to the same beneficiary over the next 5 years. Grandparents sometimes use this 5-year gift tax averaging as an estate planning strategy. If you want to explore using or setting up a 529 plan, it can be confusing, so call us and we'd be happy to assist you. Let's talk about annual gifting now. You may gift up to $15,000 tax-free to each donee in 2021. These annual exclusion gifts do not reduce your lifetime gift tax exemption. This annual exclusion gift is doubled to $30,000 per donee for gifts made by married couples. You can also help someone with medical or education expenses without incurring gift taxes. There are opportunities to give unlimited tax-free gifts when you pay the provider of the services directly. The medical expenses must meet the definition of deductible medical expenses. Qualified education expenses are tuition, books, fees, and related expenses, but not room and board. You can find the detailed qualifications in IRS Publication 950 and the instructions for IRS Form 709. They're both at www.irs.gov. A wealth transfer planning item to think about is the exemption amounts for gift, estate, and generation skipping taxes for 2021 is $11.7 million or $23.4 million for married couples. Any amount over that is subject to the 40% federal tax. This high amount of exclusion provides high net worth individuals a significant planning window to make gifts and set up irrevocable trusts. As a reminder, as of now, in 2026, the estate tax exclusion will return to approximately $5.6 million, which is $6 million adjusted for inflation. On November 26, 2019, the Treasury Department and the Internal Revenue Service issued final regulations under IR-2019-189, confirming that individuals who take advantage of the increased gift tax exclusion or portability amounts in effect from 2018 to 2025 will not be adversely impacted when Tax Cut and Jobs Act sunsets on January 1st, 2026. If you have a large estate, please call us to discuss this. Now let's review the most recent key tax law proposals from the November 3rd Build Back Better Act framework, released by the White House. Another proposal is to expand the 3.8% net investment income tax to apply to all net income derived in the ordinary course of trade or business for taxpayers with taxable income greater than $500,000 for joint filers and $400,000 for single filers. The bill also calls for a new high-income taxpayer surcharge on the top 0.02% of taxpayers, which is thought to mean individuals with a modified adjusted gross income over $10 million, increasing on incomes that are over $25 million. Note, this does not include state taxes. Although it is not yet certain which tax changes, if any, will be passed into law, we will try to update you as new laws are passed. In summary, here are some items that you should review prior to year-end for tax time. What is your anticipated tax bracket? Will you take standard or itemized deduction for timing purposes? Capital gain and loss harvesting, retirement planning contributions, education planning opportunities, charitable gifting planning, and estate tax planning opportunities. It's also helpful to think about tax planning for any major financial or life events next year or in the future, as well as tax planning for any other personal situational concerns. One of our goals is to continue to help others. Some of our best clients were referred to us by existing clients, so please feel comfortable letting us know the names of anyone who you feel could benefit from our services or information. We would be happy to add them to our mailing list. Again, one of our primary goals is to keep clients informed, and we appreciate you watching our update. Please call us if you have any questions. Thanks again for your time. Remember, your health and well-being is our highest priority. Our goal is to help you, and we appreciate the opportunity to assist you with your financial needs. Please call our office whenever you need.